Happy morning, friends. This is Sudarshan again for my Pve Wealth Creators investment bytes. Last two videos we have seen how investment instruments will be useful to attain financial freedom. We have covered fixed deposits, and last video we have seen about life insurance. Now I'm going to talk to you about mutual funds. Mutual funds plays a major role. Today's scenario, mutual funds plays a very important role in achieving our financial freedom. So how this can be used, all those things we'll discuss in this video actually. If you look at, there are people who still thinks that mutual funds are very risky kind of thing. I will not say it is not risky. Yes, it is risky. Traveling in an airplane is risky, but still people are traveling. How these people are traveling? Because of they are able to take a calculative risk. Same way, the mutual fund also, if you take a calculative risk, you are able to achieve your financial freedom with the help of mutual funds. So if you look at in mutual funds, there are various funds available. There are people think that the mutual funds is only for equity investment. It is not at all for equity investment. People who like to have a fixed return like fixed deposits, even options are available for those kind of investments with the fixed return, where people are locking money in fixed deposit for a fixed period like 3 years, 5 years. Even that kind of options is available with the mutual funds actually. It is those funds are called debt funds. And there are other I'll tell you what are the types of funds basically available in mutual funds. Broadly, this can be categorized into three categories. One is equity funds, and next is called debt funds, and the next is called liquid funds actually. Then we will see how this can be used. Basically, equity funds are funds which the money get invested into equity shares of a company. Immediately people think share means it is risky. Even on my previous videos, I said it is risk reward ratio is something like it is directly proportionate. If you take higher risk, you will get higher return. So if equity shares you are investing, yes, there is a higher risk, but there are a lot of probabilities of getting more returns actually. So this is one thing. And the next type is called debt funds. These funds are predominantly the money getting invested into various bonds available in the market. Bonds means actually there are two components will be available to that. One is the capital, another is called fixed return, which is technically we call it as coupon. Coupon is nothing but interest. So these two components will be there, and the money get invested into these kinds of bonds. Then this is called debt funds. There are third category of funds. It is called liquid funds. This liquid funds is also kind of a debt market funds, but where the money get invested into short-term kind of papers. So that is liquid funds. So I will end this video with this. You just remember in mutual funds, there are three types. One is equity, debt, and liquid. I'll end up this video with this. Tomorrow we will see how who can invest in equity funds, who has to invest in debt funds, and who has to invest in liquid funds, or maybe how to use these funds for our financial freedom. That we'll see in our next video. Thank you very much. Please like my video and subscribe for my channel so that you will not miss anything whatever I am posting. Thank you very much, friends. Bye.